The most dangerous market collapse is not the one that begins with panic. It is the one that begins with calm. That is what a liquidity trap looks like in real life. The headlines still sound manageable. The index still looks respectable. People still tell themselves that as long as the SP is near its highs, the system must be functioning normally. They glance at their account, see that the number is not yet catastrophic, and conclude that caution is paranoia. That is exactly how the trap works. It hides under the surface while the surface still flatters you. So let me give you the one mother line that everything in this story serves. The market does not break first at the surface. It breaks first underneath. When liquidity is drained faster than confidence notices, that is the line. Not valuation alone, not fear alone, not one dramatic news event that gives everyone permission to panic at once. Drainage, because once liquidity begins leaving the system in a sustained way, the consequences arrive in sequence. First, fewer real buyers stand behind the prices people have grown used to. Then weaker corners start cracking. Then financing grows more selective. Then the market becomes air, pocketed in places that the headline indices still hide. Then some apparently isolated incident reveals that what looked fine at the top was already hollow below. By the time the public agrees there is a crisis, the crisis has usually been operating for months. That is what almost everyone misses. They still think the market is mainly a screen. I think the market is mainly plumbing, and plumbing fails underground before it floods your kitchen. Now let me show you the mechanisms. The first mechanism is liquidity drain. Most investors talk about rates. Far fewer talk about quantity. That is a mistake. A financial system can tolerate higher rates for a while if liquidity remains abundant. It can also tolerate less liquidity for a while if the price of money is easy enough to cushion the adjustment. But when the system is being drained in size, when the Treasury must issue aggressively into the market while the central bank is simultaneously shrinking its balance sheet, the drain becomes structural. That is liquidity drain. Money that might have supported risk assets gets absorbed elsewhere. Balance sheet capacity gets used up. Bid depth gets thinner. Margins for error shrink. Assets that had floated because money was everywhere discover that money is now more selective about where it goes. This does not create an immediate cinematic crash. That is why it is so dangerous. It creates a hidden weakening. The public thinks in terms of price. The serious investor thinks in terms of sponsorship. Who is left to buy? Who is forced to fund? Who is absorbing new issuance? Who is surrendering liquidity that had been silently supporting the whole machine? That is the real question. Now let us move to the second mechanism. I call it the illusion stage. One of the hardest things for investors to understand is that a market can look healthy while the structure underneath it is already degrading. This is not unusual. It is normal. In fact, many of the most dangerous setups in financial history had a period where the surface kept smiling while the foundation was already cracking. That is the illusion. The broad index stays buoyant. A handful of giant names hold everything up. Financial television points to resilience. Commentators tell you that the economy is stronger than the pessimists think. And all the while, secondary liquidity worsens. Smaller companies weaken, lower quality balance sheets strain. And more the market stops participating in the optimism visible at the top. That is the illusion stage. I have seen this before. The public usually reads it as proof that the bears are early or foolish. In reality, it is often the market's final gift to the unprepared. One last period where the appearance of normality allows people to stay overexposed before the mechanism becomes too obvious to deny. This is why I never take comfort from the index alone. A healthy surface with sick internals is not reassurance. It is warning. Now we come to the third mechanism. I call it silent fragmentation. This is how liquidity crises usually reveal themselves before the break. Small caps stop participating. Credit-sensitive sectors begin sagging. Commercial real estate, linked exposures refuse to recover. Regional financial institutions trade as if the market senses more than the headlines admit. Bid. Ask spreads widen in the wrong places. Financing becomes more expensive for weaker borrowers, even though the broad market still sounds complacent. That is silent fragmentation. The market is no longer one unified organism. It is separating into what can still attract capital and what is quietly being abandoned. This matters because fragmentation is one of the cleanest signs that liquidity is no longer acting like a rising tide. In easier conditions, money spills broadly. In harder conditions, it becomes tribal. It concentrates in what still feels safe, liquid, or index protective, and withdraws from what requires more faith. This is why the average investor gets fooled. He thinks the market is fine because the symbols he recognizes on television still look fine. He does not see that more and more of the underlying system is already in retreat. That is the kind of blindness that turns a manageable drawdown into a devastating one. Now let us move to the fourth mechanism. I call it trigger hierarchy. A true break rarely arrives from nowhere. It arrives when stress finally becomes visible in a form the market cannot explain away as isolated. That could be a regional bank failure, a private market gate, a failed financing, a bond deal that cannot get done. A sudden widening in credit spreads that says the cost of risk is being repriced too fast for comfort. These are not all equally important. That is why hierarchy matters. Some signals are background noise, others are structural alarms. A 10-year yield pushing and holding above a psychologically and financially critical level matters because it changes the sovereign arithmetic and reprices duration everywhere. A regional bank index falling far enough matters because it tells you commercial real estate losses and deposit fragility are no longer theoretical. Credit spreads blowing out matter because credit is always ahead of equity when the system stops trusting itself. That is trigger hierarchy. The public waits for the headline everyone can recognize. The prepared investor watches the sequence in which private stress becomes public. That is a much more useful way to navigate. Now we come to the fifth mechanism. I call it the policy trap. This is where so many investors still cling to an old faith that no longer deserves unquestioned trust. They tell themselves that if things get ugly, the Federal Reserve will step in and save the cycle the way it always has. I understand that reflex. I also think it is weaker now than at any point in a very long time. Why? Because every previous great rescue had an escape hatch. Cut rates, flood liquidity, reflate assets, restore confidence. But in a world where inflation is not dead, where debt service is already swallowing staggering amounts of national cash flow, and where credibility has been eroded by too many pivots and too much dependence on support, the rescue is no longer clean. That is the policy trap. Keep policy tight and the debt math becomes more dangerous. Ease too fast and inflation or currency confidence becomes the problem. Print aggressively and the market may not interpret it as rescue, but as surrender. This is the essence of the trap. The central bank still has tools. It may not have painless tools. And once the market senses that, it begins pricing the limits of the rescue before the rescue is even attempted. That is why I believe a future quantitative easing cycle would not feel like 2009 or 2020. Felt the context is different. The debt burden is larger, the inflation memory is fresher, the world is less trusting. The market may still rally eventually, but the first reaction to emergency easing in a stressed inflation-prone environment is not guaranteed to be relief. That is what makes this more dangerous than people think. Now let us move to the sixth mechanism. I call it phase rotation. One of the biggest mistakes investors make in crises is treating the whole event as one undifferentiated block of fear. That is lazy thinking. Crises move in phases. Each phase rewards different behavior and punishes different mistakes. In the pre-break phase, patience and defensive positioning matter. In the break phase, speed and discipline matter. In the policy response phase, flexibility matters. In the recovery phase, the courage to rotate from defense back into offense matters. That is phase rotation. And if you cannot distinguish phases, you will do the right thing at the wrong time or the wrong thing at the right time. Shorting too late, buying too early, holding too long, staying defensive after the real pivot has already started, mistaking official words for actual liquidity, mistaking panic for the final low. This is why I prefer a playbook to a prediction. Predictions flatter the ego. Playbooks preserve capital. A good playbook tells you how much to hold in optionality, how much to devote to defense, what stress signals matter most, what changes would force you to get more aggressive, and what evidence would tell you the break is no longer just developing but fully in motion. That is how you survive and then profit, not by being a prophet, by being prepared. Now, I want to force the identity shift because without it, you will keep reacting to this. Like an index watcher, stop thinking like a market spectator. Start thinking like a liquidity navigator. A spectator asks whether the market feels fine. A liquidity navigator asks whether the system can still fund itself without hidden strain. A spectator sees all-time highs and feels comfort. A liquidity navigator looks underneath and asks which parts of the market are no longer being carried. A spectator wants the crash date. A liquidity navigator wants the phase map, the triggers, the percentages, and the flexibility to move when conditions change. That is the stronger identity. Because this is not a market where opinion is enough. This is a market where structure matters more than slogans, and it leads to a much better operating system. First, hold real optionality. Cash and short sovereign paper are not dead weight in a liquidity trap. They are future command. Second, respect asymmetric defense, selective shorts, real assets, energy, and defensive cash. Flow businesses are not there to make you feel balanced. They are there to survive a system that is being drained. Third, watch the right signals. Long yields, regional financial stress, and credit spreads tell you far more than the headline index. Fourth, separate stages. Illusion, squeeze, break, policy reaction, rotation. If you cannot see the stage, you are trading blind. Fifth, never marry the thesis. If the evidence changes, the position changes, ego is expensive. Sixth, understand that the broad market can still look healthy while the liquidity trap is already active underneath. That is not contradiction. That is how this always begins. Seventh, prepare now, not after confirmation. Confirmation is what people pay for with worse prices and smaller options. That is the heart of it. The public thinks a crash begins when fear becomes obvious. I think it begins when liquidity becomes scarce enough that fear no longer needs to be obvious for damage to accumulate. That is already happening. Maybe not dramatically enough yet for everyone to see, certainly enough for anyone willing to read the internals honestly. Now let me end where this really matters. You can keep staring at the surface. You can keep assuming that because the broad index is standing, the foundation must still be solid. You can keep trusting that if things get bad enough, the old Fed playbook will work cleanly again. You can keep telling yourself you will react when it becomes obvious, or you can do the harder thing. You can admit that the trap is already operating. You can position for phases instead of headlines. You can hold enough optionality to matter. You can respect the signals that break first. You can stop treating calm as evidence of safety when calm may simply be the final stage of denial. That is the threshold. Because by the time the break becomes visible to everyone, the easy defensive positioning is gone and the panic discounts are still ahead. That is the paradox. The right time to protect yourself is when the market still looks survivable. The right time to build a playbook is when other people still think one is unnecessary. That is the mirror. Look into it carefully. The liquidity trap does not announce itself with sirens. It drains quietly, it fragments quietly, it weakens the system quietly, and then, all at once, it makes the quiet people look prepared and the complacent people look stunned. That is not luck. That is structure. And structure is what I would rather trust than hope.